So I'm going to tell you my fourth quarter predictions for 2023 and what I think is going to happen in 2024. In the residential sector, the single family stuff, we're still going to see prices increase. Not maybe as dramatically on the 5 and 6 and 7 bedrooms, the $1.5 million houses. But what we're seeing in the market is anything that's 3 bedroom, 2 bath, 4 bedroom, 3 bath, basically your 600,000 and under is still supply constrained. And you guys remember what's going on with supply and demand, right? It doesn't matter that interest rates are going up. I mean, it does, but it really doesn't change how many people still need a home. There's over 4 million single housing units new in America right now. We need those. They're due. They're overdue. But when you're looking at houses, people are buying single family homes. They're buying $500,000 and under. We're still seeing multiple offer situations on houses like that. And we're going to continue to see that as long as the supply is constrained, even with the higher interest rates. The other part of that is the commercial sector. So then we've got the industrial, we've got multifamily, we've got office, we've got mini storage. All those fit into the commercial sector. And we're seeing prices are softening, but there's still a ferocious demand for it. We're still not going to see the $1 million non-refundable earnest monies return anytime soon, but we are still seeing people buying deals. We're back to what I would consider normal, what I've seen most of my life. A deal hits the market, the realtors talk about it, the investors, the buyers, they look at it preliminarily, they do some due diligence, they write an LOI back and forth a couple of days, next thing it's under contract, moving toward a closing in 60 days or so. That's the market we live in. That's a normal market. We're seeing a lot of that happen now, and we're seeing things trade. Obviously, with interest rates being higher and with cap rates easing up a little bit, going upward, we're starting to see those prices settle in at about 15 to 20% off the peak of 2022. That whole thing peaked in January. If it wasn't already over, it was peaking then. So we're starting to see that come down a little bit. Office, on the other hand, this was multifamily. Office, on the other hand, is falling off the edge of a cliff, right? Banks are stepping away from it. They're not wanting to get involved with it. We're seeing markets like Houston hit 23% vacancy with a negative net absorption of office space. So these are not good economic indicators. But we're also seeing that some markets are fairly resilient. Office space is still trading. We've signed a couple of leases here in Boise, Idaho in this last couple of weeks. And so we're seeing things still trade just a little bit thin. So when you're looking at your asset class, you really need to look at where you're at, your market, your demographic, what you're going after, because we're starting to see a lot of that. The other thing that we're starting to see too, because everybody likes to figure out how to involve technology in what just happened. And so we're seeing a lot of emerging trends that are putting technology back at the forefront of a sector, putting it in there to help predict, much like we saw with Zillow, 6, 7 years ago, where they were trying to tell you what your house was worth, even though nobody really knew that AI could do that. We're starting to see platforms start up that are running a traditional real estate business online. We're starting to see a lot of different things like that that are having changes in the market. Because let's just be honest, at the end of the day, if there's one thing that is truly consistent with the real estate market, it's that it always changes. It's always something new, whether that's the lack of supply of money, too much money in the marketplace, high interest rates, low interest rates. The one thing that we're not dealing with right now is high vacancies, except in office, right? So here's some of the other things that I hear. I hear a lot of people talking about the election that's coming up in 24. I hear a lot of people talking about the war in Ukraine. And while both of those do have an impact, we just got out of a 20-year war in Iraq. We've been involved in multiple conflicts since. We're now supplying funds to Ukraine. Whatever that is, we're used to a world of conflict. And so maybe this is just the next thing. Maybe it's worse than this, but it's probably just going to be one of those things that is going to continue to distract and continue to make people question and wonder. But I don't really believe that the Ukraine war is going to have a huge impact on things locally here in the United States. Job markets and consumer spending, those seem to be going all the wrong directions if you're betting on a recession. We continue to create jobs. We continue to see consumer spending at all-time highs. If you haven't figured it out, Go down to your local Chili's and try and get a seat on a Friday night. Even a Tuesday night seems to be fairly packed for whatever reason. So while we continue to see things look and feel like we've got a robust economy, we still have interest rates putting quite a damper on how people are spending that money, or more particularly, what particular things people are buying. Are they buying houses? Are they buying cars because of the interest rate? I do believe that is slowing down. But again, pent-up demand seems to be pushing that higher, farther, and faster. We're also seeing shifts in the rental market. We're seeing people move a little bit less frequently now that COVID has slowed down, but it doesn't mean that people aren't moving into new areas. We've seen rentals come online. There was a lot of stuff that got under construction and new development in 2020 and 2021. And when you're talking about building apartment complexes, those can take 3 to 4 years. So we're seeing a lot of supply come on. We're also seeing developers race to stabilize. They're trying to get their assets stabilized and get rid of the construction financing to get to permanent financing before rates continue to go up. And a lot of people are renting at a discount right now to gobble up that demand and make sure that their apartment complexes fill faster than others. And so we're seeing some changes in the market that maybe there isn't a huge supply, but there are definitely people offering concessions to make sure that they get most of the available tenants in a marketplace to make sure that they can then get to their stabilized financing. We're also seeing people look more internationally as places to invest. We're seeing a lot of people I know are looking to invest outside the United States because there are a lot of other places that people would like to invest. They can still get a decent return as compared to where we tend to be sliding sideways here in the United States. So let me know what you guys' thoughts are. These are just some of my predictions for the next 4 to 6 months. I'd love to hear your thoughts in the comments below.